Long-term investing is simple. You buy assets, you hold them for a long time. You aim to grow your money over years or decades. It's about patience, not quick profits. Think of it like planting a tree. You carefully choose a sapling, you plant it in fertile ground, you nurture it and give it time to grow. Years later, you have a strong, valuable tree. Long-term investing is the same. You pick investments that align with your goals. You give them time to grow. Over time, your portfolio blossoms, bearing the fruits of your patience. Remember, long-term investing is a marathon, not a sprint. It's about slow, steady growth over time. And it all starts with understanding the basics and making smart choices. There are many different long-term investment options. Each has its own risks and rewards. Let's look at a few popular choices. Stocks represent ownership in a company. When you buy stock, you're buying a tiny piece of that company. Stocks can offer high returns but also come with higher risks. Bonds are like loans you give to governments or corporations. They offer lower returns than stocks but are generally less risky. Real estate involves buying and holding properties like houses or apartments. It can provide rental income and potential appreciation in value. These are just a few examples. Other options include mutual funds, exchange-traded funds, and more. The key is to research and understand each option before investing. The earlier you start investing, the better. Time is your greatest ally in the world of investing. Here's why. Compounding is like a snowball effect. Your money earns interest. Then, that interest earns interest, and so on. This creates exponential growth over time. Starting early allows you to take advantage of compounding for a longer period. Even small contributions can grow significantly over decades. Let's say you invest $1,000 today at a 7% annual return. In 30 years, you'll have almost $8,000. But if you wait 10 years to start, you'll only have around $4,000 after 20 years. The lesson is clear. Start early, even if it's with a small amount. Time is on your side. Section 4. The magic of compound interest. Compound interest is the secret sauce of long-term investing. It's the reason why your money can grow exponentially over time. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, growing larger and larger. That's compound interest in action. When you reinvest your earnings, they compound over time. Your money earns interest. Then, that interest earns interest, creating a snowball effect. The longer your money compounds, the more significant the growth. That's why starting early is crucial. Even small amounts can grow into substantial sums with the power of compound interest. Section 5. Choosing the right investments for you. Not all investments are created equal. The right investments for you depend on your risk tolerance and financial goals. Risk tolerance refers to how comfortable you are with the possibility of losing money. If you're risk-averse, you might prefer lower-risk investments like bonds. If you're comfortable with risk, you might consider stocks or real estate. Financial goals determine what you're saving for. Are you saving for retirement, a down payment on a house, or your child's education? Each goal has a different time horizon and requires a tailored investment strategy. It's essential to research and understand the risks and potential returns of each investment before making any decisions. Consider consulting with a financial advisor if you need guidance. Section 6. Diversification. Don't put all your eggs in one basket. Diversification is a key principle of investing. It means spreading your money across different asset classes to reduce risk. Imagine putting all your eggs in one basket. If you drop the basket, you lose everything. But if you spread your eggs across multiple baskets, you minimize the risk of losing everything at once. The same principle applies to investing. By diversifying your portfolio, you reduce the impact of any single investment performing poorly. There are various ways to diversify. You can invest in different asset classes like stocks, bonds, and real estate. You can invest in different sectors such as technology, healthcare, and energy. You can also diversify geographically. Diversification won't eliminate risk entirely, but it's a smart strategy to protect your portfolio from significant losses.